Hey, everybody. My name's Joe Pivarunas. I'm the founder and managing editor of Nanalyze. We're a boutique media and research firm that covers disruptive tech investing for a broad audience of institutional and retail investors. Today, we're going to talk about buying tech stocks in times of volatility. And the impetus for this presentation was the time that I spent working at a financial services firm, along with a gentleman who also does presentations on this channel, our head of research, Peter Vito. And whenever there was a market crisis, our MD, who was affectionately named Helpless Satan, used to tell us to get on the phone and talk to clients. So he just wanted us always talking to clients and reassuring them that everything was fine. So whenever there's a lot of turmoil in the market, investors, whether they're retail or institutional investors, like to have communication and reassurance about what's going on. So today we want to talk a little bit about how our strategy is going to be in 2022 in terms of how we manage our own tech stock portfolio. So I wanted to start out by giving an example. So we had recently taken an office holiday, and a number of us went off to different remote places. I went to Yemen, where there isn't internet, and I didn't have access to anything for an entire week. And when I got back, I was going through emails and saw a couple, let's say, the must reads from Seeking Alpha. And here are a couple that I clipped. So one individual had said, buy Palantir before it surges in their post after their Q4 earnings announcement. And then somebody else had said to buy ahead of upcoming earnings. And these are individuals that aren't adding value because they're suggesting that you speculate. So if the earnings had happened to go well, they could point to the article and say, see what a genius I am. If they didn't, then they'll probably have some excuse for the fact that they were wrong. Now, what this sort of article tells you about the author is that this is somebody who's a speculator, not an investor. When you try to gauge which direction the market is going to go by flipping a coin, you're not adding any value to people that are reading your content. So what ended up happening with Palantir, if you're following the stock at all, is they had their earnings and things weren't up to snuff, and the stock took a dump. And that's what you see here from this short research note by ARK Invest that talks about the shares of Palantir dropping, and that also coincided with Palantir selling a large amount of Palantir after they had been acquiring this stock for quite a while. So the reason that, say, one of the factors that probably contributed to their decision is listed here as a significant deceleration in growth in the large government division, suggesting perhaps a change in government procurement behavior. Well, this is exactly why we don't invest in companies that have a majority of their revenues coming from government. You can see here in an article we wrote last April, we said in 2020, 56% of Palantir's revenues came from customers in the government segment, and we believe that represents a risk that should be avoided. So now that the market is starting to adjust, all the armchair pundits who have large Twitter followings are starting to realize that their advice they're giving isn't so accurate. And instead of constantly preaching a bullish thesis that might have worked in a bull market, they're now stuck trying to defend their bullish thesis instead of having presented both a bullish and bearish thesis. And in the case of Palantir, you now see pundits are starting to change their tone. And this is an example of, well, I don't know if this individual, what his tone was before, but he's here on CNBC and he's making a really good point about Palantir's SPAC deals. Now, we wrote about this as well in an article last year about companies that put Bitcoin on the balance sheet. What Palantir has done is made a large number of investments in SPACs. And when we put this little label here that says spreading FUD, we're going to talk about what that acronym means later. Now, when you look at the SPACs that Palantir is holding, you see a very broad and unrelated group of companies. And what this analyst at Credit Suisse is saying is that what Palantir is doing would be almost akin to what Ginkgo does with their related party revenue, something kind of shady like that. So they're making an equity investment in one of these firms, and then the firm takes the cash from the equity investment and turns around and gives it back to Palantir in the form of payments for their software platform. And this individual's talking about how you can dig into the financials and look at what percentage of their revenues this makes up. Now, we haven't done that because we don't spend a lot of time looking at companies that we've decided are too risky to invest in, but it's just another red flag that came across our radar, which is why we didn't invest in Palantir. Now, today, the market is showing a lot of, let's say, turmoil and volatility. And I wanted to talk a little bit about greed and fear. So there's a gentleman that we admire a lot, Warren Buffett, who says something to the extent of, be greedy when others are fearful and be fearful when others are greedy. So I wanted to talk about fear. This is a really interesting signal that you can get. It's called VIX. It's the volatility index, and it shows fear in the market. It doesn't necessarily show pure volatility. It shows a 30-day forecast of what they're gauging volatility in terms of fear. Now, you'd have to read the definition to understand how that works, but as you can see, this is quite interesting. I put two arrows here. That first arrow on the left refers to the 2008 financial crisis when everybody panicked. Now, between that time and the next arrow, which represents the coronavirus panic, you see some blips on the left-hand side, but it's relatively smooth. So even though the market was climbing to the moon over those years, the VIX remained relatively low, and it works very well in pointing out when the market's actually afraid, not when the market's going up significantly or going down significantly, but when the market is very scared. You can see in March of 2020, there was a nice spike. And then to the right of that, you can see that with the recent developments in Russia, that investors are starting to become a bit spooked. So when you look at your tech stock portfolios and you see everything in the red, you think that we're in the middle of a huge correction, and now is the time to be greedy because everybody's fearful. Well, people aren't that fearful yet. And the fear that was exhibited around March 2020, when there was that meaningful market correction of around 10% in a single day, that blip, so we'll talk about here in a second, was nothing. So here is a chart, a 5-year chart of the NASDAQ. The red arrow points to that blip, all right? So the market dropped then, and then afterwards, it's done nothing but, well, for almost 2 years now, just go up. Although recently we've seen I guess you could call it a correction, right? How you define a correction, how you define a bear market, these can be defined different ways. But if you just look at this chart using common sense and say to yourself, how much has the tech stock market actually corrected? You can see on the right-hand side here, it's sitting around 13,700. And then at the right prior to when the pandemic hit, it was sitting around 9,150. Now, there's one way to look at it, and this is how we view it. If the pandemic had no damage at all to the market, none, then perhaps this chart would make sense, right? But it did have damage. It decimated $1 trillion travel industry. We're still not able to measure all the effects that we're realizing in the global supply chains from the bullwhip effect, et cetera. So pre-pandemic till now, the market has risen 50%. You might say, well, the productivity that was realized from tech stocks offset the negatives from the negative effects from the pandemic. And perhaps that is the case, but then you should see a net of zero or a marginally increase over time as opposed to this 50% increase. So if we presume then that the market may go back to pre-pandemic levels, that's a 33% drop that has yet to take place based on today's levels. So whether or not we're in the middle of a correction is questionable. Calling a bottom. Had a lot of people talking about, oh, you should buy this stock because it's at great price, or this stock is at a bottom, you'll never see it cheaper. Well, this is impossible to do even for the most sophisticated investors. And because a lot of people like to look towards ARK and see what they do, this is a stock chart for a company that ARK had bought, and the red arrow points to when things fell, and that company had gone to around $10 a share, and ARK backed up the truck and then said, well, that was just an absolute no-brainer because You'll never see that stock at these prices. And it was just a clear must buy. Well, trying to call the bottom is really difficult because just days ago, that stock fell lower than the previous bottom that ARK thought it had reached. Now, everybody is guilty of doing this. It's almost impossible not to do this when you're an investor because it's just really tempting. Now, for us, this stock happens to be Invitae. We have been buying Invitae over time and stopped we would buy a bit and then we would wait until it fell, let's say 20 or 30% below our cost basis. We buy a little more and we were doing that over time until we had allocated our capital, and we're now sitting 60% under our cost basis on this position. So just because you think that you're buying a stock cheaply and just because you're doing it slowly over time doesn't mean you're going to end up in a situation where you're significantly underwater on a position. And what do we do when that happens? We do nothing unless our thesis changes. So this is an example of a stock that would have been very difficult to try to call a bottom on, as is every other stock. It can certainly keep falling. Now, the other thing to make note of here is we were doing our update of the tech stock catalog and report, noting that a number of the stocks that we're holding are now changing size buckets. This is really interesting. So whilst they may have been a medium-sized company, they're now moving to a small company. And why is this relevant? Well, we've, as risk-averse investors, set target allocations for the percentage of stocks in each bucket that we'd like to be holding. You can see them along the bottom here. And then when you look at what we're actually holding, you can see we're overweight small caps. And maybe that's offset by the fact that we're overweight mega caps, but our sweet spot would be large caps, and we are currently underweight those. So when we're looking at which companies to add as time goes on and the stock market continues to fall, we want to be really cognizant about the fact that there are a lot of small caps out there that exhibit a great deal more volatility than larger companies. Now, one way when you're looking at your portfolio, your tech stock portfolio that's covered in red ink, one way to make yourself feel better is to go look at the other stuff that you've invested in. So you can see here's our asset class allocation. You can see our tech stock portfolio, which used to be 22% of all our assets, now sits at around 17% of our assets. Now, that may be a little bit depressing, but not when we go look at how some of our other asset classes are holding up. So wine has actually been doing quite well, surprisingly well. Quantigens, our dividend growth investing strategy, those dividends keep piling in, and the amount of dividends keeps increasing over time. The overall portfolio itself has held up quite well. So there's always something to celebrate if you're sufficiently diversified across asset classes. Now, there's in terms of the strategy going forward into 2022, we're going to be moving very slowly on anything that we do. So we recently published a piece on Schrodinger, the AI company, and we had made some comments and said we wanted to wait until year-end results were out before we added the company. There's no reason that we shouldn't add some shares, but we want to wait for that. And that given Wall Street's high expectations set for companies, we wouldn't be surprised if shares took a dump, even though if they had great earnings. Well, what did shares do? They were up, I think, around 12% at market open, and they closed up over 20%. So that's what happens when you try to call what a particular stock is going to do. Though we would still say that the majority of cases, because growth investors have such high expectations, the majority of cases that we've seen leading up until now, as sentiment perhaps is changing now, are that investors demand such high growth that no matter what a company says, they still punish it. So we had said here our plan is that we might add shares if an opportunity arises. Well, has an opportunity arisen? Well, what we're going to do is go through. So Schrodinger had their year end, what was that, on Friday. I took a look at that. Some of our subscribers were asking about what to do, and we certainly don't tell people what to do at all. We tell them what we might do, and what we're going to do is take a good look over the weekend and see what good news was given. We can very easily see here that for the fourth quarter of 2021, they did quite well, it appears, but we need to look at the bigger picture, and to do that, we need time. So we're going to take a good look at that, and we're going to move slowly when we make decisions going forward because we're in absolute no hurry. As long as that VIX keeps going up, as long as investors stay fearful, we're going to be moving very slowly because we just don't know where the bottom is. And when we move to add to our positions, we're going to do that using dollar cost averaging very slowly. When we look at adding new positions, we're going to approach that equally as slowly. So just to conclude, some takeaways: don't try to ape ARK. So they're a very sophisticated and large active asset manager. And if you try to mimic what they're doing, it's going to be an absolute mess. Avoid red flags. As we said before, in a bull market, everybody preaches the bull thesis because they're going to be right because everything's moving up. We always, as risk averse investors, look for red flags and look for the bearish thesis. Well, that starts to bubble to the top when the market starts to go down and everybody kind of switches their tune. So regardless of what the market does at any given time, you should always be looking for red flags. Palantir is a good example of red flags that could have been avoided. Be greedy when others are fearful, but don't try to call the bottom. So for everybody out there that thinks a particular stock is a buy at a particular dollar price, that's not how it works. When we do buy shares, we do so using dollar cost averaging. Diversify across asset classes, of course, as we mentioned earlier. And our takeaway going into 2022 is to move very slowly. So if you have questions or comments, drop them in the comment section on YouTube. Thanks so much for your time. And don't hesitate to reach out to us via email or, as I said, in the comment section with your questions. And we'll look forward to talking to you in the future. Make sure you subscribe to our YouTube channel as we continue to pump out new content throughout the rest of the year. Thank you very much.